When launching a hedge fund, the first major decision a manager makes is geography. You have the offshore world, defined by tropical jurisdictions, and the onshore world, anchored in dense U.S. corporate centers. But the legal domicile you choose acts as the structural DNA of the fund. It dictates your exact tax obligations, the legal framework you operate within, and specific regulatory burdens you manage. Globally, two jurisdictions dominate this space. The Cayman Islands serve as the primary offshore vehicle, while the state of Delaware is the standard for onshore U.S. structures. Because these two locations operate on completely different accounting models, choosing the wrong one can immediately lock out the specific investors you want to attract or create absolute chaos for your back-office team. This chart graphs the core trade-off, operational complexity on the vertical axis against tax efficiency for U.S. investors on the horizontal. Cayman sits down here, offering straightforward operations but poor U.S. tax efficiency, while Delaware demands heavy operational lifting for optimized tax outcomes. We will strip away the legal jargon and look precisely at how the accounting and tax mechanics function inside these two dominant structures. A fund's domicile dictates the daily reality of every subscription, every redemption, and every period-end control. The Cayman exempted company is the standard offshore vehicle. It uses a traditional corporate structure, meaning it issues actual shares to its investors. This matrix shows how the structure works. Investors buy and redeem based on a uniform net asset value per share. This single metric keeps reporting straightforward. But when multiple investors buy in over time, accountants must apply strict series accounting to track specific fee terms. From a tax perspective, the Cayman Islands operate as a tax-neutral jurisdiction. There is no income tax levied at the entity level. This setup eliminates complex U.S. tax reporting, making it the default choice for non-U.S. investors, as well as U.S. tax-exempt entities like pension funds, endowments, and foundations. The Cayman structure shields those specific groups from cross-border tax headaches. But because it lacks pass-through tax deductions, it is highly inefficient for everyday U.S. taxable investors. This balance sheet demonstrates a major drawback. The manager's performance fee is treated entirely as a standard expense. By deducting the fee as an expense, total fund assets decrease and the NAV per share drops. The math is clean for the accountant, but there is a heavy cost for the fund manager. Because that payout is categorized as fee income, the IRS taxes it at the highest possible ordinary income rates. Treating performance compensation as a straightforward P&L expense keeps the balance sheet tidy, but it penalizes the manager with an unfavorable tax bill. Moving onshore to the United States requires navigating the rigid, highly structured legal environment of American corporate partnership laws. Here, the Delaware Limited Partnership, or LP, is the standard vehicle, and it entirely abandons the concept of shares. In the capital account model, there's no uniform share price. Instead, investors hold a percentage interest based on their individual capital balance. Accountants must rigorously maintain and reconcile every single LP's individual capital account, eventually summing them up to reach the total fund NAV. The payoff for that extra accounting work is pass-through tax status. Delaware LPs issue Schedule K-1 forms to each investor, allowing U.S. taxable investors to claim specific deductions and optimize their individual tax outcomes. But there is a trap called UBTI, unrelated business taxable income. If the Delaware LP uses borrowed money to trade, that leverage creates taxable income. For a tax-exempt pension fund, that triggers toxic tax liabilities on money that is normally protected. The Delaware LP provides highly flexible, optimized tax outcomes for U.S. taxable investors. However, the severe risk of UBTI forces tax-exempt pensions and endowments to avoid the onshore structure entirely. Delaware LPs also solve the manager's tax problem. Instead of taking a traditional performance fee, the fund utilizes an incentive allocation, widely known as carried interest. Look at how the mechanics change. The manager's cut bypasses the expense line entirely. A percentage of profits is reallocated directly from the limited partners' accounts into the general partner's capital account. This preserves its long-term capital gains character, saving the manager millions in taxes. Incentive allocation forces the fund accountant to execute a complex, highly manual equity roll forward. But for the manager, preserving that capital gains tax status makes it a non-negotiable feature of the fund. If you launch a fund using only one of these domiciles, you automatically cap your growth by alienating half the potential capital in the market. This flowchart illustrates the industry standard workaround, the master feeder structure. A manager sets up both vehicles simultaneously. Non-U.S. and tax-exempt investors route their capital through the Cayman feeder, while U.S. taxable investors route through the Delaware feeder. Both vehicles then pool that capital down into a single master fund where the actual trading happens. This architecture allows the manager to accept capital from any investor demographic, optimizing the tax structure for everyone. The trade-off is a heavy operational cost. This structure instantly doubles the back-office overhead. Accountants must run dual reconciliations, calculating NAVs for the Cayman side and individual capital accounts for the Delaware side, all while managing entirely different regulatory deadlines at the same time. Cayman and Delaware operate as specialized financial tools. Understanding how to execute the distinct accounting and tax mechanics of both is the defining requirement for operating a modern fund.